Welcome back to the deep dive. Today, we're jumping into something pretty interesting, looking at where HR meets, well, behavioral finance, I suppose.
That's a good way to put it.
Yeah, we're focusing on a huge area that often gets overlooked: strategic employee rewards software. Specifically, how smart companies are using digital gift cards for recognition looking ahead into 2025.
Right, it's evolving fast.
And recognition, I mean, we're not talking small change here, are we? It's big business.
Oh, absolutely not.
Our sources show U.S. businesses spend something like $176 billion a year on non-cash rewards. That's just huge.
It is. It's a massive investment.
So here's the puzzle then. If companies are pouring that much money into it, why do so many still struggle to actually prove the ROI?
That's the million-dollar question, or maybe the $176 billion question.
Oh, yeah.
Look, that massive spend often gets kind of neutralized by three really critical pain points we see again and again in the research. First, just the sheer manual effort. HR teams literally bog down with spreadsheets trying to distribute rewards. It sounds archaic, but it's common.
Still. Wow. Okay, what else?
Second, tax compliance. It's complex, confusing, and honestly, a lot of companies seem to get it wrong or just hope for the best.
Uh-oh. We'll need to dig into that one. And the third?
Limited analytics. They're spending the money, but they can't easily connect that spend back to hard metrics, things like lower turnover or better productivity. They feel it works, but they can't prove it.
Got it. Manual work, tax headaches, and no real data.
Exactly. And so the mission, really, for this deep dive, based on what we're seeing, is to show you the strategic payoff. What happens when you tackle those problems head on with the right technology?
And there is a payoff.
Oh, absolutely. The sources are quite clear. Organizations that make that shift, the ones using structured strategic recognition software, they see, on average, a 31% lower voluntary turnover rate.
31%, that's significant.
It's huge. And critically, it's not just about retention. They also managed to document, on average, a 12% increase in productivity metrics.
Wow.
So this flips the script, right? It stops being just a nice-to-have appreciation thing and becomes a measurable competitive edge, especially now with how tight the labor market is.
Okay, that frames it perfectly. It's moving from just thanks to actual workforce management.
Precisely.
But hang on, this brings up something sort of counterintuitive that jumped out from the sources. Why gift cards? I mean, why do employees actually seem to prefer a gift card over just plain old cash?
Yeah.
We all need money, right? Wouldn't cash be king?
You'd think so, wouldn't you?
Uh-huh.
And that's the psychological trap that a lot of companies fall into. It seems logical, just give cash.
Right.
But think about it. When you get a cash bonus, say, through your regular payroll,
Right.
where does it typically go?
Bills, groceries, the mortgage. Just disappears into the general fund.
Exactly. It gets absorbed into routine, necessary expenses. The car payment, the rent, maybe paying down some debt. Poof, it's gone.
And you forget about it pretty quick.
Precisely. The recognition feels transactional, almost clinical. It just blends in with your regular paycheck. There's no lasting positive feeling tied back to the company or the achievement.
Yeah, I can totally see that. If I get an extra, say, $200 cash, it just offsets my credit card bill that month. A week later, I've honestly forgotten I even got it. Zero emotional connection left.
Right. And this is where the behavioral finance angle comes in. It's a concept called mental accounting.
Mental accounting.
Gift cards kind of force you, the recipient, to mentally earmark that value for something different, something special, maybe a bit indulgent, purely enjoyable.
So it's not bill money, it's treat money.
You got it. It's designated for a splurge, a personal treat, something fun you probably wouldn't just buy out of your regular salary. And that transforms the work reward. It becomes a positive emotional experience.
And that experience creates a stronger link back to the employer.
A much stronger, more lasting association. You remember the nice dinner, the new gadget, the spa day, and you remember why you got it and who gave it to you. It connects to the achievement and the employer brand.
That makes sense. What about choice? Does that play a role?
Huge role. Beyond the mental accounting, gift cards nail what behavioral scientists call choice architecture.
Okay.
By offering a curated selection of gift cards, maybe retail, restaurants, experiences, they give you flexibility and control. It satisfies that deep psychological need we all have for autonomy.
So you feel like you're choosing your own reward.
Exactly. But it's guided choice. It still steers you away from just paying the utility bill. And this flexibility is key for making the reward resonate across a really diverse workforce,
Mm.
right? Different generations, different cultures, different interests. A $50 restaurant voucher might thrill one person while another wants an Amazon card. Autonomy is crucial for genuine engagement.
And the tech side. Does speed matter here?
Immensely. Modern systems allow for digital delivery, which means it's instant or near instant.
No waiting for a check in the mail or for the next payroll cycle.
Right. And the research backs this up. Timely recognition, delivered quickly via these automated systems. It increases the likelihood of the employee repeating that desired behavior, the thing they were recognized for, by about 40%.
40%, just from being faster.
Compared to delayed rewards that crawl through the old, slow HR processes, yes. Speed and the intention behind it really matter. Immediate gratification reinforces the link between action and reward.
Okay, so the psychology makes sense, the choice matters, speed helps. But I have to push back a bit here. Let's talk about the downside you mentioned. Taxes.
Ah, yes, the compliance beast.
If the goal is strategic recognition, but the value is taxable anyway, just like cash, why bother with the gift card complexity at all? Doesn't dealing with tracking and W-2s just add more admin burden compared to just giving a cash bonus and being done?
That is the perfect pivot, because this is precisely where companies, even really big, sophisticated ones, stumble. They fall right into the IRS trap.
The IRS trap sounds ominous.
It can be. Moving into compliance, the single biggest hurdle we found, the most common mistake, is this widespread but wrong belief about a de minimis exception for rewards.
Ah, the idea that small gifts don't count.
Exactly. People think, oh, it's just $25 or maybe under $100. The IRS doesn't care. It's too small. De minimis.
And that's not true.
Not for gift cards. The critical point, according to IRS regulations, and every single HR and payroll person needs to burn this into their memory, is that all gift cards given to employees are considered taxable income. Full stop.
All of them, regardless of amount.
Regardless of amount, they're treated as cash equivalent benefits. That de minimis rule generally applies to things of nominal value that are hard to track, like maybe occasional snacks in the break room or a very infrequent low-value physical item like a holiday turkey, perhaps. But gift cards, they have a readily ascertainable cash value, no exception.
Wait a second, so let me get this straight. If a manager gives out, say, a $15 coffee shop gift card as a spot reward, technically, the company is breaking federal tax law if they don't track that, report it on the W-2, and handle withholding.
Technically, yes, that's the letter of the law. Now, enforcement on tiny amounts might be low risk, but scale that up across thousands of employees and frequent rewards. It becomes a massive compliance risk, a potential audit nightmare.
Wow, okay. That is genuinely shocking. I bet loads of companies aren't doing that correctly.
It's extremely common not to. But to stay compliant, organizations must report every single gift card's value on the employee's Form W-2 as supplemental wages.
Just like a bonus.
Exactly. Which means it's subject to federal income tax withholding, Social Security taxes, Medicare taxes, FUTA taxes, the works.
And doing that manually, tracking every $10, $25 card.
Across hundreds or thousands of employees. For multiple rewards programs, the administrative burden alone is just staggering. Forget the tax risk for a second, just the work involved is huge.
Okay, so that manual approach is basically untenable for compliance.
Pretty much. And it also raises that important question you touched on. What does this mean for the employee receiving the reward?
Right. Because if it's taxed, like cash,
The value gets hit immediately.
Right.
That $100 gift card you thought you were giving. After standard payroll tax, withholding, let's say, around 28% combined average rate for federal, state, FICA, the employee might only effectively have $72 in actual spending power from that card.
so the perceived value drops instantly, just like getting a cash bonus on your paycheck, seeing the gross amount and then the net amount after taxes.
Precisely. The tax treatment is identical, which underscores why accurate tracking and reporting are so vital. You need detailed documentation. Who got what, how much, when, and you absolutely need that process coordinated tightly with your payroll systems and your main HRIS platform.
It sounds completely impossible to manage effectively without automation. You'd need an army of clerks.
Exactly. Which brings us neatly to the solution category, these modern integrated recognition platforms. The technology exists now specifically to automate all of this, the distribution and the compliance nightmare. It turns that liability into an asset.
Okay, so let's talk about these platforms. They're obviously more than just sending a digital card, right?
Ooh, way beyond that. We're talking sophisticated employee engagement software.
Yeah.
Think platforms like, well, HR Cloud's Workmates is one example mentioned in the sources, but there are others. They offer a suite of capabilities.
Like what specifically? What should people look for?
Key things are automated compliance tracking. This is crucial. It needs to integrate directly with payroll for proper W-2 reporting.
Takes that burden off HR's shoulders.
Completely. Second, look for custom digital storefronts. Not just 5 gift card options, but hundreds. Amazon, Target, restaurants, travel, experiences, genuine choice and personalization.
So that autonomy piece we talked about is built in.
Yes. And third, this is really important for adoption. Native integration with the tools employees already use every day.
Like Slack or Microsoft Teams.
Exactly. Making recognition visible within those collaboration hubs. It massively boosts adoption rates. People see it happening, they engage with it. It becomes part of the daily workflow, not some separate system they have to log into.
Visibility drives culture.
Absolutely. And that automation isn't just about compliance. The data we reviewed shows that when organizations deploy these kinds of platforms, they slash the internal administrative workload associated with rewards by an average of 60%.
60% reduction in admin time? That's huge for an HR team.
It frees them up for more strategic work. It basically eliminates those tedious, error-prone manual tax tracking and reporting tasks that just drain resources.
Okay, so efficiency is clear, but let's connect it back to the bigger business outcomes you mentioned earlier.
Right, the bottom line impact. We already hit the 31% lower voluntary turnover, but the data also shows these systems help drive a 56% higher overall employee retention rate compared to companies that have unstructured or maybe just annual infrequent programs. People feel seen more consistently.
56% higher retention, and let's put some real numbers on that for you listening.
Good idea.
The sources consistently estimate that replacing a single employee costs on average about $4,700. And that's just direct costs, recruiting, interviewing, onboarding, initial training. It doesn't even count lost productivity.
Right, the hidden costs are often much higher.
So think about it. If you're an organization that typically replaces, say, 100 employees a year, reducing that turnover by 31%, that means you avoid 31 departures.
31 times $4,700.
That's nearly $150,000 in direct cost savings annually, just from retaining those people through better, more strategic recognition. That's before you even factor in the productivity gains.
And the data really does show that link. Strategic recognition, the kind enabled by these platforms, drives engagement levels that are reportedly 12 times higher than generic, non-strategic, check-the-box programs.
12 times. Okay, so the tech solves the admin and compliance, enables the psychology, but how do we make the reward itself strategic? Surely a one-size-fits-all gift card isn't the answer.
No, absolutely not. And this is where the best platforms allow for real tailoring. Different workforces, different industries, they need different approaches. The sources really emphasize moving beyond generic stuff.
So industry-specific strategies.
Exactly. Think about healthcare. What are the realities? Intense stress, long and irregular shifts, high burnout risk.
Yeah, definitely.
So the most meaningful rewards there often acknowledge that reality. Things like wellness or spa gift cards, maybe credits for fitness apps or healthy meal services. Even local restaurant vouchers can be great, helping accommodate those tough shift schedules where planning a family meal is hard.
Okay, that makes sense. Tailored to the job's demands. What about, say, tech?
Tech sector, often a different demographic, right? They might value innovation, personal development, lifestyle integration. So what works well there?
Apple gift cards.
Often, yes. High-end tech is popular. But also experience-based rewards, travel vouchers, unique entertainment options. Even specific gaming or streaming service gift cards can align really well, considering the interests and often higher discretionary income in that sector.
So you match the reward type to the likely interests and values.
Precisely. And then think about manufacturing or maybe frontline retail workers. Often their priorities are more centered on practical utility, family life.
So less about experiences, more about usefulness.
Generally, yes. The source examples were things like Home Depot or Lowe's gift cards practical for home projects, grocery store vouchers, family-friendly restaurant chains. For these workers, tangible utility that supports their home life often resonates more deeply.
So the key isn't just the dollar amount, it's really understanding the employee's context, matching the reward's utility to their daily reality, their job, their home life.
You've nailed it. And once you've got the right kind of rewards identified, the platform lets you get more sophisticated with how you deliver them.
Like tiered programs.
Yes, exactly. Implementing tiered recognition. Maybe it's a 25 olive local coffee card, for hitting weekly goals consistently, or for demonstrating company values. Then maybe a $100 retail card for solid quarterly performance. And perhaps a really significant reward, like $500 or more in travel or flexible spending for exceptional annual achievements or major project milestones.
So it scales with impact.
Right. And you can even weave in company culture more deeply.
How so?
Well, say sustainability is a core company value. You could curate your gift card options to include eco-friendly retailers, brands known for ethical sourcing, or maybe even allow donations to environmental charities as a reward choice.
Or supporting local businesses if community is a big focus.
Perfect example. It turns the reward itself into another way to reinforce your company's ethos and values. It's not just a transaction, it's a statement.
That's smart. Okay. For someone listening who's thinking, right, we need to do this, what does implementation actually look like? Is it a huge, long project?
It doesn't have to be. The sources suggest a typical implementation runs somewhere between 30 and 90 days. It's usually broken down into phases.
Okay. What are they?
Phase 1 is usually foundation building. This is where you define your recognition policy clearly, get the technical integration set up with your core HR and payroll systems, that's key, and do the initial training for managers on how and why to use the system.
Get the basics right first. Makes sense. Then what?
Phase 2 is often a pilot launch. You roll it out to maybe one department or location. This lets you gather real-world feedback, work out any kinks, and start building internal awareness and excitement before a full launch.
Test the waters. Smart.
Then Phase 3 is full deployment. You open it up company-wide, maybe introduce more advanced features like peer-to-peer recognition if the platform supports it, and really establish those metrics for tracking ongoing performance and ROI.
So foundation, pilot, full deployment. Seems manageable.
It is, especially compared to the ongoing pain of manual processes or the risk of non-compliance.
Okay, let's bring this all home. If we circle back to that huge $176 billion spend we started with, what's the single biggest takeaway from this deep dive?
I think the core message is the shift in mindset. It's about moving away from thinking of recognition as just reactive, often manual appreciation.
Which feels good but is hard to measure.
Exactly. And moving towards strategic, data-driven engagement that demonstrably impacts the bottom line. We saw the proof points, that 12% productivity boost, the critical 31% lower voluntary turnover. That's strategic impact.
It's about making appreciation work for the business, not just in the business.
Well put. And for organizations wondering, okay, how much should we be investing? There's actually some solid guidance.
Oh, what do the best practices suggest?
Industry benchmarks consistently show that successful, mature recognition programs typically involve allocating around 1% to 2% of total payroll towards formal recognition and rewards.
1 to 2% of total payroll.
Yes. And viewing that not as a cost center, but as an investment that, when managed strategically through the right platform, demonstrably yields a positive ROI through reduced hiring costs, higher retention, and better productivity.
That's a concrete number people can take back to their finance teams. Okay, final thoughts. Where is this heading?
The future in this space looks pretty exciting, actually. We're already seeing trends towards more AI-powered personalization. Imagine systems suggesting the perfect reward based on an employee's past behavior, stated preferences, maybe even their public Slack channel activity.
Wow, hyper-personalization.
Exactly. There's also talk of blockchain-based reward systems for enhanced security and transparency. And definitely more integration with broader corporate goals like sustainability, think carbon-neutral gift card options becoming standard.
So the tech will just get smarter and more integrated.
For sure. Which means the strategic question facing organizations really isn't whether they should implement systems like these anymore. It's more about how quickly they can get effective, integrated systems in place. Systems that really turn appreciation from a fuzzy concept into a sharp, measurable, competitive advantage. Something to definitely think about as you plan your budgets and your HR strategy for the coming year. Fascinating stuff.